Hello and welcome back. Today we will be taking a look at EQCL, which is the Horizons Enhanced All Equity Asset Allocation Covered Call ETF. As the name suggests, this is again an income oriented ETF, and of late I've noticed that this ETF has gained some popularity online. So I thought this is a good time to do a review of this ETF. As always, I will go over the overall strategy of the ETF, discuss the holdings, and also some of the risk factors that we should at least consider or be mindful of before making this ETF a part of our portfolio. With that said, let's get started. So we begin with the holdings. As you can see on the screen, this ETF is actually a collection of other ETFs. One way to look at it is that it is a highly diversified ETF, not only in terms of industries and sectors, but also in terms of geography. So the first holding over here consists of US large cap companies. The second holding consists of international developed markets like Europe and Australia. The third holding consists of Canadian large cap companies. The fourth one consists of emerging markets like India, China, and South American countries. And the last one consists of the NASDAQ 100 index within the US, which is mostly tech focused. So, in a way, you're covering the entire globe and also covering almost all the different sectors available. So, in that sense, this is highly diversified and very safe. Another thing you might notice is that if you add up all the weightage percentages on the right, the sum total will be approximately 125%. And that is because this ETF uses a 25% leverage. I'm not a big fan of leverage, but at 25% is not exactly a big risk. And in general, we do see this practice among a lot of covered call ETFs, where by using the extra leverage, they're able to generate slightly higher income. So, if we wanted to summarize this ETF strategy, we can say that it uses a highly diversified portfolio to minimize risk, but at the same time, they are using a 25% leverage to increase the income and the overall return of the ETF. In terms of distributions, this ETF has paid out only 3 months worth of distribution, and that makes sense because it is still relatively new on the market. Every month it has given out 19.5 cents per share, which, if we do the math based on its current share price, gives us an annual distribution rate of approximately 11.5%, which, in my opinion, is actually quite good for such a diversified ETF. Even its management fee is comparable with other similar ETFs on the market. So, based on my initial review, I was quite impressed with this ETF and couldn't really find any major flaws. But then I reviewed its holdings for a second time because remember, this ETF is a collection of other ETFs. And I did find one important risk factor that needs to be discussed. This particular risk factor is quite unique to the Horizons ETFs. It has got to do with the way Horizons manages its index funds. Now, in general, most regular index funds simply hold the stocks within that index in the required weightage. However, with Horizons, they use something called a total returns index strategy, which is quite useful in some ways, but also it has some additional risk factors. So let's just first understand what this total return index strategy is. So if you scroll down on this page on the Horizons website, you will find the explanation of how the total return index strategy works. In a nutshell, instead of holding the actual stocks within the index, Horizons uses something called total return swaps, which is a form of derivative to replicate the return of that index on a daily basis. Now you might wonder why I do this instead of easier way of simply holding the actual stocks. Well, this strategy is useful for saving on taxes because in case of indexes where you're actually holding the stocks, there are times when you receive dividends on those stocks, and if you're holding that index in a non-registered account, then you end up paying taxes on it. But in this strategy, since you're simply replicating the total return of that index, including the dividend, it gets added into the stock price of the index fund. So you're not actually paying any taxes because you're not receiving any income or dividend on that index fund. So this is really a strategy for minimizing the taxes. But in order to do this strategy, there is one important risk factor, which is the counterparty. As you can see on the screen, Horizons is mainly holding cash, which is pledged to the counterparty, and it is the counterparty which guarantees the return of that index. Now, in general, this counterparty is mostly a highly accredited bank. And based on the information I've found online, in case of Horizons, it is the National Bank of Canada. It is the sixth largest bank in Canada, and as such, you can think of it as among the too big to fail banks. However, we have already seen in the US in 2023 that it is not impossible even for some of the biggest banks to go down. Another important thing to note is that the counterparty risk is not something static, but it keeps varying from one month to another. So, it could range from anywhere between 0% to 40% of the total portfolio of the ETF. This means that you could be exposed to no risk at all in a given month, or in a given month, you could lose as much as 40% of the portfolio if the bank ends up defaulting. If you want to learn more about swap based ETFs, you can check out this article, which briefly explain how they work and also the risk factors associated with the total return index funds offered by Horizons. I've put the link in the description. I must also admit that the fund managers at Horizons do try their best to keep the counterparty risk to a minimum, and ideally, they try to keep it below 10%, which does minimize the risk factor overall. So, in the end, it may not end up being something that has a major impact on the ETF's performance in the long term, but it is good to be aware of it nonetheless. Lastly, I do want to highlight the fund's efficiency in terms of how it is organized. Now, this is really a matter of personal opinion, and depending on how you look at it, it could end up being a good or a bad thing. So, let us first just take a look at its holdings once again. If we look at the five holdings this ETF has, you will notice that only three of those five holdings are actually generating income: the US Large Cap ETF, the Canadian Large Cap ETF, and the NASDAQ 100 ETF. At the same time, the International Developed Markets and the Emerging Markets ETFs are simply held as growth stock. So, again, if someone is more income oriented, they may think of it as a slightly less efficient way of managing the ETF, where you could have had income being generated from these two holdings as well. Whereas, in my opinion, I am a bit of a growth and income oriented investor. So I would like to think of it as a positive, that you're getting income, and actually, as I mentioned earlier, we are receiving an 11.5% income from this ETF at its current stock price on an annual basis. So this is really good, even though it is coming only from three out of the five holdings. So in my opinion, this is actually not a bad thing, but some people may think of it as being slightly inefficient. There is one other factor, however, where I think this fund could have been more efficient, and that brings us back to the total return index strategy, which is used in each of these ETFs either directly or indirectly. Now, the total return index strategy, if you think about it, is really designed for growth. In fact, it takes away whatever income you could have received within the fund and adds it to the growth of the ETF. On the other hand, if you look at the covered call strategy, it is doing the exact opposite. It is taking away some of your growth and giving it to you in the form of income. So these are really polar opposites of each other when you think about it. And in this ETF, they have combined both these strategies. And I just think that could have been more efficient if they had simply used the stocks directly instead of the total return indexes as the underlying holdings for all the ETFs. Because what happens is when you're holding stocks directly, you're getting the more organic income, which is in the form of dividend. And in addition, on top of that, you're receiving the covered call income. So you're receiving a combination of dividends and covered calls, which is the total income from a regular covered call ETF. Whereas in this ETF, they're first removing the dividend and adding it to the growth. And then on top of that, they're simply writing covered calls to give you the income. So the only income in this case that you're receiving is just covered calls. There is no dividend in the stock. And I just feel that could have been more efficient if they had simply managed it by directly buying the underlying stocks rather than using these ETFs. Because that would have allowed them to reduce the percentage of the portfolio which is used for options writing. And maybe it might just then further improve the overall performance of the ETF in terms of capital gains. Because remember, part of the income in that case would have come from the dividends, so the need to write options would be reduced. But this is not really a make or break deal for me. Overall, if you look at the fund, it is designed to be an income plus growth ETF. So we should be able to see some growth in terms of the stock price. And in addition, we should continue to receive the income, which so far has been consistent. And that's my review of this ETF. Let me know in the comments section what you think about this ETF and if you would like to make it a part of your portfolio. As always, the information shared in this video is mainly just based on my own research and my opinions, but it's important to make your own due diligence before making any financial decisions. So, thanks again for watching. Don't forget to like, share, and subscribe. I'll see you guys in the next one.